All right, so today let's dive into this idea of cheap investments.
Yeah.
You know, those hidden gems we're always trying to find.
Mm.
But what does cheap actually mean? Like when we're talking about investing?
Yeah, that's a really good question. Because I think cheap can be a little deceptive. We often use things like the price to earnings ratio, the PER, to kind
Hmm.
of gauge value. Like it's a quick way to see how much you're paying for every dollar of, a company's
Right,
earnings.
like that lemonade stand example.
Yeah.
You know, if it costs $10 to buy and makes $1 profit each year, then its PER is 10. Simple rate. But here's the thing. Our sources are showing that these classic value metrics, well, they haven't really been performing that well lately. Like,
Hmm.
they've been significantly lagging behind the market as a whole.
Yeah, that's right.
Yeah.
For example, over the past decade, the MSCI World Value Index, which focuses on companies that are considered undervalued, has delivered less than half the returns of the regular MSCI World Index, which tracks the broader global market. And what's really puzzling is that the MSCI World Value Index, it currently has a forward PER of just 14. So by like traditional standards, that should make it a bargain. But it seems like there's something else going on here.
So what are we missing? What's changed in the market that's making these classic value metrics, you know, maybe less reliable?
Well, one crucial factor our sources highlight is return on invested capital,
Hmm.
or as it's better known, ROIC. It's basically like, think of it as a measure of how effectively a company uses its money to make more money, to generate profits. And this is where things get really interesting, because a lot of the leading companies, especially in the US, they're actually prioritizing long-term growth over immediate profit.
So instead of like squeezing out every last dollar today, they're reinvesting heavily in things like research and development, building strong brands, and creating those network effects that really lock in those customers.
They're kind of playing the long game, right?
Exactly. And that's why their PER ratios might look high at first, in the short
Right.
term, because they're not just focused on maximizing their earnings right now. Instead, they're investing in building a future that is sustainable and profitable.
Okay, I'm starting to see how this all connects. So, like a high PR, it doesn't necessarily mean a company is overpriced. It could actually be a sign
Yeah.
that they're making smart investments,
Exactly.
for the future.
Exactly. And that's why this idea of ROIC
Yeah.
is so valuable, because it gives you that deeper understanding
Mm.
of a company's strategy and how they're allocating their capital, for that long-term growth. Our sources actually use car companies as a really good example of this. You might have two car companies with, similar performance in the market, but their ROICs can be completely different. And that explains why they might trade at very different multiples, right? Even if their short-term earnings look similar, their long-term potential, as measured by this ROIC, could be totally different.
Exactly. Take Tesla, for example. They have a very high ROIC and a very high market valuation. This shows the market's confidence in their ability to, you know, generate those returns, even if their earnings right now might not be as high as some other car
It's
companies.
almost like you're looking beyond just the sticker price and trying to understand the engine that's driving the whole car.
That's a great analogy. And this brings us to another interesting example from our sources. Intel. They're spending a ton of money on research and development, but their ROIC is currently pretty low. And this raises a really important question for investors. Is this a sign of trouble, or is this like a potential turnaround in the making?
Right. Are they just throwing good money after bad?
Yeah.
Or are they making strategic investments that will pay off down the road? It's almost like a detective game, trying to figure out their long-term strategy.
Exactly. You have to look beyond the simple metrics, to really understand the nuances of their business, their competitive landscape, and their vision for the future.
This whole ROIC concept is really eye-opening. It seems like it's essential for understanding the true value of a company, especially in today's market where so many companies are prioritizing that long-term growth over those quick profits. But this kind of brings up another question for me. If ROIC is so crucial, is this why even Warren Buffett, the king of value investing, has kind of struggled to beat the market in recent years? Our source seems to hint at that a little bit.
You're right. And the source actually mentions a previous episode where they really dove into this very topic. It seems that even the most successful value investors are having to adapt to this changing market.
So we're seeing that cheap isn't quite as straightforward as it used to be. ROIC is definitely a vital piece of the puzzle. But is there anything else we should be considering when we're
Right.
trying to find those undervalued companies?
Yeah, there's another factor that our sources discuss that's been impacting the performance of value stocks, particularly in the US, and that is the rise of something called intangible assets. intangible assets.
Intangible assets. Okay, I'm curious. What are those exactly, and why are they like changing things up?
Well, intangible assets are things that you can't physically touch, but they have a huge amount of value in today's economy. Think of things like brand recognition, patents, software, data, even those network effects we were talking about.
So it's not just about, owning factories and equipment anymore. It's more about owning the ideas, the
Oh,
innovation, those connections that drive value in this digital age.
exactly. And the shift towards intangible assets, that's a big reason why. Those traditional value metrics might be falling short. Those
Yeah.
metrics were developed at a time when tangible assets were everything.
Right, so company.
Yeah.
With a giant factory.
Yeah.
Might have looked really cheap
Mhm.
based on its book value,
Mhm.
but that factory might not be that valuable in a world where it's all about software and data.
Yeah, that's a great point. The real value might be in the algorithms running on their servers, the data they're collecting, or the brand loyalty they've built online. It's a totally different way to think about value.
It's like comparing a horse and buggy to a Tesla. A horse and buggy might seem cheaper based on like old school measures, but the Tesla clearly holds the real value today.
Exactly. And again, that's why understanding that ROIC is so important. It lets us look beyond just the old metrics and see how effectively a company is using all its resources, not just the physical stuff, to make money.
So it's not just about how much they're spending, but how they're spending it right. Are they investing in those intangible assets that will actually, drive growth and profits down the road?
Exactly. And this is what makes it so interesting for investors. You almost have to become like a business analyst,
Hmm.
try to understand the whole competitive landscape, identifying those companies that are building the right moats and investing in the right intangible assets.
Wait, moats?
Ew.
Like with a castle?
Yes, like a castle moat. It's this metaphor. Warren Buffett uses it all the time to describe a company's competitive advantage. Think of it like a barrier that makes it really hard for competitors to get in and steal their business.
So a strong brand name, loyal customers, special technology they've developed, those are all moats.
Exactly. Those are all moats.
So a company might have a low PER, but if they don't have a strong moat, their profits are at risk and their, long-term potential could be really limited. They might look cheap, but not really be a bargain.
That's it. You're getting it. It's not just about the price. It's about the whole picture, understanding how the business works and what its chances are in the long run.
This is really insightful. So we're learning that cheap isn't just about a low price. It's about understanding,
Yeah.
the ins and outs of a business, its strategy, the competition, and how well it's using its money, both the tangible and intangible stuff.
That's right. And that requires, a different kind of thinking. You can't just look at simple numbers anymore. You really need to understand the story behind those numbers.
So if we had to summarize this, what are the key takeaways for someone who wants to be a better investor?
Okay, well, first, remember that cheap is relative. Just because a company has a low PER doesn't automatically make it a good investment. And a high PER doesn't necessarily mean it's a bad one. You have to look at the whole picture.
Okay, so context matter.
Context matters a lot.
What else?
Second, you got to look beyond the surface. Don't just rely on those basic numbers. You need to dig deeper. Understand the company's strategy, their competitive advantages, those moats we were talking about,
Yeah.
and their potential for growth in the long term. You have to understand the story behind the numbers.
Right. Okay, so basically become a detective
Exactly.
with a third takeaway.
And third, be patient if you're investing in companies that are focused on long-term growth. You have to be patient too. Investing is a marathon, not a sprint.
Okay, that makes sense. So we've learned that cheap is more complex than it seems. It's not just about low prices. It's about understanding value. In a market that's constantly changing, we've talked about ROIC, intangible assets, and those competitive moats. But is there anything else our listeners should be thinking about?
Yeah, that's a great question. And this leads us to another really crucial insight from our sources. This whole shift towards long-term growth and intangible assets. It has some big implications for how we as investors need to approach the market.
So you're saying, like, if companies are kind of shifting their focus
Yeah.
to this long-term growth, does that mean we as investors
Yeah.
need to shift our thinking too?
That's exactly what I'm saying. If companies are playing the long game, investors probably need to adjust their own timelines.
So you're saying we need to be more patient, more willing to kind of ride out
Yeah.
the ups and downs of the market and focus on that, long-term potential.
Exactly. If you're investing in companies that are building for the future, you got to have that long-term mindset yourself. It's like planting a tree. You don't expect to see fruit the next day, right? You got to give it time to grow.
That makes a lot of sense. So it's not just about finding a company with a low PER. It's about understanding their vision, their ability to innovate,
Yeah.
and their potential to create value over time.
Right. You need to look beyond the short-term noise and focus on those fundamentals.
So we're talking about those moats again, those protective barriers that help companies stay ahead.
Exactly. You got to find the companies that are building those moats, the ones that can really defend their position in the market.
This has been a really fascinating deep dive. We've gone from basic PER ratios to intangible assets,
It's a
competitive moats, and this whole evolution of value investing. But before we wrap up, I have one last question. If this shift towards long-term growth is the new normal, does that mean the days of short-term trading are over?
That's a great question to think about. Is the market really rewarding patience more than ever before? It's something for everyone to consider as you navigate the world of investing.
Well, this has been an incredible conversation. I feel like we've really uncovered what cheap truly means in investing. It's not just about finding the lowest price, it's about understanding what makes a business truly valuable. Thanks for joining us for this deep dive. Until next time, keep learning and keep exploring.